Hello, and today we're going to be talking about lesson 1-2. So chapter 1, lesson 2, this is accounting 1, and we're going to discuss how business activities change the accounting equation. If you remember from yesterday, we were learning that assets equals liabilities plus owner's equity. So we have everything drawn on a T. And whatever our assets is has to be equal to liabilities plus owner's equity. So if liabilities is 5 and owner's equity is 5, our assets had to be 10. So today we're going to move on. And the first section we're going to talk about is what to do when we are receiving cash. There is a couple definitions that you need to be sure that you know. And we will be using this a lot. The first definition is a transaction. A transaction is a business activity that changes assets, liabilities, or owner's equity. So everything we do is going to be a transaction. Everything in business, if a business is buying something, if a business is paying a bill, if a business is receiving cash, if a business makes a sale, if a business is paying for their rent, those are all transactions. So everything we do is going to be based on a transaction. When we are recording our transactions, we need to make sure that we understand the accounting concept, the unit of measure. The unit of measure is when a business transactions are stated in numbers that have common values. So that may sound kind of complicated. It's really not. It just means that if you start out recording everything in dollars, you continue recording everything in dollars. You don't record some things in dollars and some things in pesos and some things in a euro. Everything must be recorded consistently using the same common value. So, moving on, we're going to have our very first transaction. So, we're going to talk about what to do if we receive cash from the owner as an investment. This is typically your very first transaction you will ever have in a business, because an owner, before they can ever start their business, they're going to have to put in some of their own money. So the first transaction will be receiving cash from the owner as an investment. If you have the labels that I printed out for you, great. We're going to be using 1-2, transaction number 1 to begin with. If you don't have these labels, these are directly straight from the book. It just helps if you put it in your notes. That way you can keep track of what your notes are saying. And as we're taking notes for chapter 1, I want you to put this page on a page all by itself, because we're going to be coming back in chapter 2 and chapter 3 and continuing to take notes on the same page we used for chapter 1. So this transaction, we're going to look at it 3 different times in chapters 1, 2, and 3. So it'd just make more sense to have it all on the same page. So Miss Park is going to take $5,000 of her own money, and she's going to invest it into her company, Techno Consulting. Now remember that Techno Consulting needs to understand the business entity, and the business is not concerned with Miss Park's personal transactions, so she has to record this, that she gave the money to the business, then the business could spend it. So transaction number 1 says that on August the 1st, we received cash from the owners as an investment of $5,500. Well, there's a couple things we need to look at. First of all, we're going to summarize everything depending on accounts. So we're going to take this and break it apart into different accounts and figure out which account title these parts belong to. So if we go back to our accounting equation, let me draw it again here. Assets equals, draw my T, liabilities plus owner's equity. Okay, so under our assets, we're going to have accounts for everything we have here. So an asset is anything that is going to be of value. Remember we learned that at the very end of the last section. An asset is anything of value that is owned. So in here, received cash from the owner as an investment. I can see two accounts, and one of them certainly has value, which is the cash. So my cash is going to be an asset. So I'm going to go ahead and put cash here. So I know that that's what's happening with that one. Okay, the next thing I need to decide is, do I have another asset? Or do I have a liability or an owner's equity? Okay, if you remember, a liability was anything that was owed. Sorry, I meant to do these in different colors. So anything that we owe anybody. Do we owe anybody anything from this one? No. There's nothing where we're buying something from someone else or needing to pay a bill. So the other thing that we had was owner's equity. An owner's equity, if you remember from the last section, is the amount remaining after the value of all liabilities is subtracted from all assets. Okay, this is also going to include what is called capital. Capital is another vocabulary word. We'll write those down here in a minute. And it's the account used to summarize the owner's equity in a business. So anytime the owner makes an investment, we're going to record that under owner's equity. Anytime the owner takes money out of the business, we'll record that under owner's equity. And anytime the business has shown a profit, after we do our summaries, then we would record that in owner's equity, or if they took a loss, we would take it out of owner's equity. So I don't want to confuse you too much, but just know that our owner's equity, because we made an investment, that's going to be capital. So let's see if we can start this out. Okay, to begin with, everything was zero. We had zero in cash. We have zero in liabilities. And we have zero in owner's equity, because this is our very first transaction ever. So we're getting some cash. So she is giving us $5,000. Sorry, it looks like I have a typo up here. That is $5,000. So go ahead and correct that on your paper. And so we're going to record that under cash because she gave us $5,000. Okay, and we have to record it somewhere else because right now we are out of balance, and our accounting equation must always be in balance. So we're either going to have to subtract $5,000 from the assets, or we need to put something under liabilities or owner's equity. Well, we've already decided that our investment is a capital, so we're going to put our $5,000 under capital. So does $5,000 equal $5,000? It does, so our account is in balance. So we're ready to go to our next type of transaction, and I'm going to go to a different page because we're going to come back to that one in chapters 2 and 3. In this one, we're going to be paying cash. Okay, and so this is transaction number 2. Which says that on August the 3rd, we paid cash for supplies of $275. So, I'm going to draw my accounting equation again. And I'm going to start abbreviating owner's equity as OE and liabilities as LIAB. And I didn't do those in color again. I'll just draw a little box around them. And you don't have to use colors. I just am a person who thinks colors helps me to recognize and see what is going on. Okay, so for this one, we started out, if we remember from our last one, what we had, this time we're going to add another one. So we had cash as an asset. So I'm just going to put cash here. And we used our capital over here, which was Kim Park Capital, because Kim Park is the name of our owner. And they caused the accounting equation to change. So under cash, we now had $5,000. And under Kim Park Capital, we now had $5,000. Okay? So in this one, it says we paid cash for supplies. So we've got to pick out what is our two accounts we're going to be using. You're going to always have two accounts. Sometimes you may have more than two accounts. But two is typically what you're going to use. So if you look through here, paid cash. Well, we know that we have an account called cash. And we know cash is something of value, so cash is an asset. So I'm going to circle that with my blue. Then we're going to look and see, do we have any other assets? Well, supplies. Supplies, does that have value? Does the copy paper in the closet or your pencils in the closet have value? They do have value, so that's another asset. Okay, we don't have, that's it. We've only got the two things. So we're going to have two assets in this transaction. So let's go ahead and break this down. And I should clarify, cash does not just necessarily mean paper dollar bills. Cash is typically a check whenever it's a business. It can also be a business using their debit card or a credit card. But cash is just referred to as cash. So if we're paying cash, are we going to increase or decrease the amount of cash we have? Well, think about it. If you go to the grocery store with $100 and you spend $75, do you have more or less cash? Well, your cash decreased by $75. So in this case, we're paying cash, so our cash is going to decrease. So we're going to come over here and we're going to put minus $275. Now I said we have to have the other thing, which is supplies. So supplies is an asset, so I'm just going to put supplies here. Make it a column. I'll go ahead and draw a line across here. Okay. We'll pretend that's straight. And then are we going to increase or decrease supplies? Well, we're buying supplies, so is the amount of supplies in our closet going up or are they going down? Well, now the supply before we went to the store, we had nothing in our supply closet. Now we have $275 worth of supplies in our closet. So that's going to go up. So I'm going to put a little plus sign here. Okay, we're done with the transaction, and after you're done with the transaction, you should always double check to make sure everything's in balance. So we started with $5,000 in cash. We spent $275. That's going to leave us with $4,725. Supplies, we started with $0. We now have $275. Oops. And the other thing was our capital. We started with $5,000. It did not change, so we still have $5,000. So if I add $4,725 plus $275, that is going to equal $5,000. So that means that our accounts are in balance, and we are good to go for that one. Okay, we're going to go ahead and go to transaction number 3. So I'm going to get a different piece of paper. And this one, oh, nope, we're not. Sorry. This is still for paying cash. So transaction number 3, we're going to pay cash again. This time we're going to pay for our insurance. So I've got another sticker here, and I'm just going to put it right up here at the top. And this one says on August the 4th, we paid cash for insurance. So let's break this transaction down. Do we have any assets? Anything of value? Yes, we do. We have cash. That's our easy one. Always look for cash. If you find cash, then that's an easy one. Then you can look for your other things. Okay, paid cash for insurance. Now, insurance can get confusing. When you buy insurance, you're buying it ahead of time. That means it's called prepaid insurance. Your car insurance company does not let you drive your car for 3 months and then send a check for the 3 months you drove your car, because chances are if you didn't have an accident, you don't want to pay for that 3 months. So they want their money up front. So it's called prepaid insurance. And every day that goes by, you've used a little bit of your insurance. Now, in a business, we don't move our insurance from something that is prepaid, so it's a value, to an expense or liability. So we do that at the end of our accounting cycle. So paid cash, we know that cash is our asset. And so since I said insurance is, I'm just going to tell you insurance is an asset, and we're going to call it prepaid insurance. So I'm going to circle that one in blue. And I'm going to come over here and put prepaid insurance. Okay, because we're buying it ahead of time. So it's kind of like our supplies. We bought all of our pencils ahead of time, and even though until we use them, they still have some value. We could still return them. Prepaid insurance, until your time is up or until that policy, that day has been used on your insurance, you can cancel your policy and get a refund. So let's look at this one. We paid cash. So what's going to happen to our cash? Is it going to go up or is it going to go down? Okay, if you're paying for something, anyways, whenever I pay for something, I have less cash. So I'm going to put minus $1,200 here. The other thing is insurance. So if our cash went down by $1,200 because we just bought $1,200 worth of insurance, our prepaid insurance is going to go up. So I'm going to put plus $1,200. Okay, that's all we have in this transaction. So we'll draw our total line and we'll go ahead and figure our total. We had $4,725. We just spent $1,200. We're down to $3,525. Plus, nothing happened to our supplies. We didn't use any of those, so we still have $275 worth of supplies in the closet. We now have $1,200 worth of prepaid insurance. We didn't have any activities for liabilities. I'm just going to go ahead and put a 0 here so we don't get confused. And nothing happened to our capital. Oh, I was supposed to be writing capital in purple. That was 5,000, not 500. Okay, you guys, I hope you caught that as we were going along and yelled at your screen to save it. So if you can see what I've got here. Okay. That is what to do when we pay for cash. The next kind of transaction, now I'm going to go to my next paper, is going to be transactions on account. Okay, and what a transaction on account is, first of all, we're going to buy supplies on account. Meaning, I went to the store, I bought some supplies, but I didn't pay for them with cash. I told the store to charge it and then send me a bill, typically at the end of the month, and then I'll pay it. So when I'm buying supplies on account, I'm not paying for it now. I'm going to pay for it later. So I don't pay for it now. I pay later. Typically, you can hear this said as charge it. If you're familiar with, sometimes Richardson's does this. For example, whenever I buy things for the concession stand for FBLA, I don't carry a school check down to Richardson's to buy the stuff that I need. I go in and I say charge it to my FBLA account at the school. At the end of the month, they send me a bill, and then our secretary will write out the check to pay for that. So this is going to be transaction number 4. Which says on August the 7th, we bought supplies on account from Supply Depot. Okay. I'm going to skip down a little bit here before I draw my accounting equation again. It's the exact same one we've been doing. So I have my assets equals liabilities plus owner's equity. I'm going to pause this while I copy the whole thing down because we need to see everything that we've already done. Okay, so what I didn't list every transaction we had already done. I just listed the balances. So at the end of the last transaction, we had cash with a balance of $3,525, supplies $275, prepaid insurance $1,200, and we had a liabilities of 0. Our new account is going to be accounts payable for Supply Depot. And we had Kim Park Capital with $5,000 still. So to break apart our transaction, kind of like dissecting a sentence, we bought supplies on account from Supply Depot. What is our asset? That's anything of value. So supplies have a value. The next type of account in there, I've already told you, is going to be accounts payable for Supply Depot because we bought them on account from Supply Depot. So we list that as accounts payable hyphen Supply Depot. And it was for $500. So to clarify this transaction, we just got some supplies. So what are we going to do with our assets on our supplies? Did our supplies in our closet go up or did they go down? Well, they went up by $500. So I'm going to put a plus $500. So now we have to have another change. So either something else on our assets had to go down to leave us in balance, or something in our liabilities or owner's equity had to increase. So that's going to be our accounts payable for Supply Depot is going to increase. So we're going to put plus 500 here because we now owe Supply Depot $500. So the amount we owe has went up. So if I draw my line and check our balances, nothing happened to cash. Our supplies went up to $775. Nothing happened to our prepaid insurance. Our liabilities now went up to $500 for our accounts payable Supply Depot. And our capital remained the same. Okay, so the next transaction type we have, and the reason why I left this big space up here, transaction number 5, I'm just going to go ahead and put it here, says that we're paying, this time we're going to pay cash on account. I almost didn't leave myself enough room. So this time we're paying cash on account, which means simply that we are paying our bill. We are paying what we charged. Okay? So if we break apart this equation or transaction, paid cash, well, there's our cash, so we're going to circle that. We know that that's an asset because that's a value. And we also know that on account means that that's going to be a liability, and this one was for Supply Depot for $300. So we paid cash. Is our cash going to go up or is it going to go down? Well, since we paid cash, it's going to go down. So I'm going to subtract $300. Did anything happen to our supplies? Not now, our supplies increased earlier whenever we charged a bit, but now we're paying it. So nothing is happening to supplies. Nothing is going to happen to our prepaid insurance. What's going to happen to our liability? Well, we owed $500. Is the amount we owed going to go up, or is it going to go down? It's going to go down because we are paying them $300. So we didn't pay the whole thing off, but we made them a partial payment. And then our owner's equity, nothing happened to it. So we'll draw our line across here. And once we do our math, we'll see that now we only have $3,225 in cash. We still have $775 worth of supplies. Oops, I should have been doing those in blue. Our prepaid insurance is still $1,200. Now I'll use the red. Our liabilities, 500 minus 300 is 200. And our capital did not change, so it is still $5,000. Okay. So I hope this has made sense to you. Basically, all we've done throughout this section is taken the transaction, which is every time we do something in a business, broke it apart, put it into our accounting equation. The main thing is, remember that your accounting equation must always be in balance. And so if we have an asset do something, we need to have another asset either do the opposite, or we need to have the same thing happen on the other side of the equation. So just make sure and double check after every transaction to make sure that you are still in balance. Because I can add all three of these numbers together, and I can add those two numbers together, and I'm going to get the same thing. So if I add these together, I should get $5,200. And if I add these together, I should get $5,200. Okay? I hope my math is correct. Be sure before you come to class that you have all of your notes taken. Go ahead and make sure you have the terms for review. You need to have transaction, account, account title, account balance, and capital written in your notes. And go ahead and look at the audit your understanding questions. I want you to go ahead and write those into your notes. So your questions for this chapter, we're going to go ahead and do it on a separate sheet of paper. So audit questions. I do want you to go ahead and write out the question. You don't have to write it exactly. The first one is what must be done if a transaction increases the left side of the accounting equation. So I'm just going to put if left side increases, what must you do? I want you to go ahead and answer those three questions. Sometimes these will be used as a bell ringer quiz. Sometimes we will just discuss them in class. So be sure you answer those. And then tomorrow in class, we're going to go ahead and do the work together, the on your own, and application problem. So I'll see you tomorrow.